You could have 20 stocks in your portfolio and still be dangerously concentrated. You could be paying thousands in unnecessary fees without realizing it. And you could be taking more risk than someone who owns half as many investments. Here is the crazy part. Most people think portfolio optimization means finding better investments. It does not. The biggest gains can come from changing how your investments work together. Today, I am going to show you 7 portfolio secrets that many beginners never learn. Secret number 5 could completely change the way you invest. And number 7 is the one almost everyone gets backwards. Before we begin, remember that this video is educational. It is not individualized financial, investment, legal, or tax advice. Every investor has a different situation. Let us start with the mistake that is quietly damaging millions of portfolios. Secret number 1. Your portfolio is probably not as diversified as you think. You own an S&P 500 exchange-traded fund. Then you add a technology fund. Then Apple, then Microsoft, then Nvidia, then another growth fund. Congratulations. You now own a bunch of different ticker symbols that may be exposed to many of the same economic forces. This is where investors get fooled. They count positions instead of risks. Imagine I give you 10 umbrellas. That sounds useful until you realize they are all sitting in the same closet. You do not need more umbrellas in one place. You need protection from different types of storms. That is what real diversification is about. Do not ask only, how many investments do I own? Ask, what percentage of my portfolio depends on the same thing going right? Does most of it need large American technology companies to keep outperforming? Does most of it need interest rates to fall? Does most of it depend on strong consumer spending, cheap credit, or one region of the world? Those questions reveal risks that a list of ticker symbols can hide. Diversification does not mean every holding must rise at a different time. It means the portfolio should not be built around one fragile assumption. Once you start looking through the labels and studying the underlying exposures, your portfolio can look very different. Secret number 2. Stop chasing the investment that just went up. Here is a psychological trap almost every investor encounters. Something goes up 50%. You see it everywhere. Friends mention it, social media repeats it, headlines explain why it is changing the world. Your brain says, I need to buy this before I miss the opportunity. But you are looking at the past and calling it the future. This is performance chasing. It feels intelligent because you are buying something that has already proven itself. It feels safer than buying something unpopular. Markets, however, do not reward you simply because an investment performed well yesterday. The important question is not only whether the company, fund, sector, or theme has a good future. The important question is how much of that good future is already reflected in the price. A wonderful investment bought at an extreme price can produce disappointing results. A boring investment bought with reasonable expectations can sometimes do surprisingly well. That does not mean you should automatically avoid anything that has risen. Momentum can persist, and strong businesses can remain strong. The point is that recent performance is not an investment rule. Instead of asking what is hot, ask what job this investment performs inside the overall portfolio. Does it add a genuinely different source of return? Does it reduce dependence on an existing position? Does it match the goal and timeline? Or are you buying it because the chart makes you afraid of missing out? That single question can prevent a lot of bad decisions. Secret number 3. The most dangerous risk is often the one you do not notice. Imagine a portfolio containing a technology fund, a growth fund, several mega-cap technology companies, and a broad American index. On a statement, those holdings have different names. In a market shock, they may behave like one position. That is concentration through correlation. Correlation measures how investments move relative to one another. It is not perfectly stable, and it often changes when markets become stressed. Assets that looked moderately different during calm conditions can suddenly fall together when investors rush towards safety. This is one of the biggest portfolio blind spots. Diversification is not about making sure every position has a different name. It is about making sure the portfolio is not dependent on one underlying outcome. If your entire portfolio needs low interest rates, rapid economic growth, generous valuations, or one sector to behave a certain way, you do not really have 15 independent bets. You have one big bet wearing 15 different costumes. There is another layer here. Your income and career can also be correlated with your investments. If you work in technology, receive company stock, and invest most of your savings in technology funds, a single industry downturn could affect your portfolio, your compensation, and your job security at the same time. Your financial life is the real portfolio. The brokerage statement is only one part of it. Secret number 4. Your best portfolio is not necessarily the one with the highest return. This sounds wrong, but stay with me. Imagine portfolio A earns more over a long period, but occasionally falls 50%. Portfolio B earns slightly less, but its downturns are much easier to tolerate. Which portfolio is better? On a spreadsheet, portfolio A may win. In real life, the answer depends on the investor. The spreadsheet cannot tell you what you will do when your account is down 40%. Will you hold? Will you panic? Will you sell? Will you stop investing? Will you abandon the plan at exactly the wrong moment? If you sell during the crash, the theoretical long-term return no longer matters. You interrupted the strategy. This is why the perfect portfolio is not the one with the highest return. It is the portfolio you can actually stick with. Your behavior is part of your investment strategy. Risk capacity and risk tolerance are related, but they are not identical. Risk capacity is your financial ability to absorb losses. Someone with a long timeline, stable income, emergency savings, and no near-term need for the money may have high risk capacity. Risk tolerance is your emotional ability to experience volatility without making a destructive decision. The portfolio must respect both. A strategy that looks sophisticated but causes sleepless nights, panic selling, or constant changes may be worse than a simpler strategy with a slightly lower expected return. Secret number 5. This boring thing can be more powerful than finding the next winner. Fees. Not exactly exciting thumbnail material, but the effect becomes fascinating over time. You cannot control what the market returns next year. You cannot control whether a stock crashes. You cannot control the timing of the next recession. But you can control many of the costs you pay. Those costs may include fund expense ratios, advisory charges, transaction costs, bid and ask spreads, platform fees, and the hidden cost of frequent trading. Each individual charge may look small. The problem is that costs compound too. Imagine 2 portfolios with similar investments and similar gross returns. One consistently loses a little more to fees and trading friction. The other keeps those costs low. Over a few weeks, the difference looks trivial. Over decades, it can become significant because every dollar paid in costs is a dollar that no longer compounds for you. Before buying an investment, do not ask only, what is the expected return? Ask, what am I paying to get this exposure? What am I actually receiving for that fee? Is the service valuable? Is the strategy genuinely different? Is there a simpler way to achieve the same objective? The lowest fee is not automatically the best choice. Advice, planning, tax coordination, and specialized exposure can have real value. The important point is that every cost should have a reason. If you cannot explain what you are receiving for the fee, that is a problem. Secret number 6, the tax secret many investors ignore. Investors often obsess over pre-tax returns. What actually matters is what you get to keep. Depending on where you live, which accounts you use, how long you hold an investment, and what you buy or sell, taxes can materially affect the final outcome. Sometimes portfolio optimization is not about buying something better. It is about avoiding an unnecessary taxable event. Constantly selling, switching funds, chasing opportunities, and reacting to headlines can feel productive, while quietly creating extra costs and tax consequences. Sophisticated portfolio management often looks surprisingly boring. Fewer unnecessary moves, more deliberate decisions, a clear reason behind every change. Account location can also matter. Different investments may be more or less suitable for taxable, tax-deferred, or tax-free accounts, depending on the rules that apply to you. Rebalancing can sometimes be accomplished with new contributions rather than selling. Charitable giving strategies, loss harvesting, and withdrawal sequencing may also matter in some situations. But tax rules vary by country, state, account type, and personal circumstances. This is an area where qualified professional advice can be valuable. The general principle is simple. Do not optimize the portfolio before considering what happens after taxes and costs. Secret number 7, the secret that changes everything. Forget the idea of finding the perfect portfolio. There is no perfect portfolio. There is only a portfolio that is appropriate for your objective, your timeline, your financial situation, and your ability to handle risk. If you need the money in 2 years, your portfolio probably should not be designed like the portfolio of someone investing for 30 years. If you are investing for several decades, your strategy can potentially look completely different from someone funding a home purchase, tuition payment, or near-term retirement. That is why the first question should not be, what should I buy? The first question should be, what am I trying to accomplish? Then, when will I need the money? Then, how flexible is that date? Then, what could cause this plan to fail? Could inflation reduce purchasing power? Could a market decline arrive just before the money is needed? Could an emergency force an early withdrawal? Could concentration expose the goal to one sector, company, or economic theme? Only after answering those questions should you start thinking about investments. Many people do this backwards. They choose investments first, then try to force their financial goals around those investments. A goal-first process does the opposite. It defines the destination, the time available, the acceptable range of outcomes, and the risks that matter. Then it chooses a portfolio designed for that job. Professionals think about the goal first. So here is the final reveal. Portfolio optimization is not about having the most sophisticated portfolio. It is not about owning 47 exchange-traded funds. It is not about finding the next 10-time stock. And it is definitely not about constantly changing your investments. It is about building a system where your risks are intentional, your diversification is real, your costs are controlled, your taxes are considered, and your strategy is something you can stick with when the market gets ugly. The portfolio that looks incredible during a bull market means nothing if you abandon it during a crash. Remember the question from the beginning. You could own 20 investments and still be making one giant bet. That is the first thing to check. Open your portfolio. Forget the ticker symbols for a moment. Look at the underlying exposures. Ask yourself, if one economic theme goes wrong, how much of my portfolio gets hit? Then ask, if that decline happens, can my financial plan survive it? Can my behavior survive it? Do I have enough liquidity to avoid selling at the worst time? The answers may surprise you. In the next video, we will build a portfolio stress test that shows how different exposures could behave during a major market decline. Knowing what you own is one thing. Knowing how the portfolio behaves when everything goes wrong is where the analysis becomes useful. If this video helped you see your portfolio differently, save it and review your holdings with the 7 questions in mind. Diversification, performance chasing, hidden correlation, behavior, fees, taxes, goals. Those are the levers. Next, the portfolio stress test.